Hello everyone, welcome and thanks for watching the Market Report. This show airs every Tuesday on Cointelegraph Markets and Research YouTube channel. On today's show, sponsored by XGO, we'll be covering Bitcoin's rally above $30,000, Michael Saylor finally going back to profit, Tether blacklisting a miner's address, and the bright side of Ethereum's Shanghai fork expected for April 12. Our first news, written by our Australian friend Stephen Kate, covers Bitcoin 30-day rally totaling 46%, reaching its highest level in 10 months. Bitcoin hits 30K to mark highest price since June 2022. Bitcoin has hit price heights not seen since mid-2022, with the largest crypto by market cap touching 30K and setting a new high for the year. Some analysts predicted that it would regain its 30K as traders await the United States CPI, the Consumer Price Index, the inflation metric, on April 12, which will give insight into the Federal Reserve's battle against inflation. Well, in my opinion, that's Marcel talking, that's not Cointelegraph official advice. That's completely nonsense. Bitcoin's rally started way before macro analysts started discussing the next inflationary data. More precisely, Bitcoin rallied 43% between March 10 and March 19, so some 3 weeks ago. And even gold touched $2,000 more than 2 weeks ago. So yes, inflation is a concern, but that has been priced in some 2 or 3 weeks ago, both in gold and Bitcoin. So I don't think that the recent rally towards 30K can be tied to the CPI print that's going to be released on April 12. Additionally, the text brings an interesting statistic on the Fear and Greed Index. Since last week, Crypto Fear and Greed Index has remained firmly within the greed territory, with the latest April 11 update showing a score of 68 out of a possible 100. So greed indicator at 68. The Crypto Fear and Greed Index aims to numerically represent the current emotions and sentiments. The index also hit a score of 68 on March 21st, marking its highest level since it recorded a number above 66 in November 2021, just days after Bitcoin's all-time high of $69,000. For me, this seems very inconsistent. The market cannot have the same greed right now as it had when it touched $69,000 in November 2021. It makes no sense in my opinion. Moreover, if we watch the top 10, top 80 coins, none of the top 80 coins gained over 20% over the past week. When the market enters greed mode, it is very common for a couple of altcoins, maybe 5, 10 of them, to jump more than 20% within a week, and that did not happen. Michael Saylor, the founder and executive chairman of business intelligence firm MicroStrategy, has been an outspoken advocate for Bitcoin and has been leading the charge for corporations to adopt cryptocurrency as a strategic asset. MicroStrategy has added billions worth of Bitcoin to its balance sheet, currently owning 140,000 Bitcoin for a total purchase price of $4.17 billion. So this guy invested the company's own money, its holdings, and even leveraged some of the position to buy 140,000 Bitcoins. That's for MicroStrategy. He also has a stash from himself that he bought a little bit earlier than the company, which is not accounted over there. That's only the holdings of the company. And the company's average price was little under $30,000. So for the first time in almost a year, it went the position became profitable. So yes, MicroStrategy's position uses leverage, but not like the regular futures contract that you can trade on Binance or CME. They've used the company's own revenue as a collateral. So it's a loan, a regular business loan, which they used the money to buy Bitcoin. Moreover, their liquidation price is closer to $3,400, so really, really low. And they've recently repaid some of the outstanding loan by issuing MicroStrategy shares. So they issued new shares to pay out for the loan. So their liquidation price is even lower than $3,400. MicroStrategy has been steadily increasing its Bitcoin holdings since its first purchase in August 2020, even with the ongoing crypto bear market. That's a perfect example of diamond hands. The company has been buying Bitcoins irrespectively if it's been a month of rally or if Bitcoin price has been trending down. So that's the correct way to do it. If other companies should want to understand how to use Bitcoin as a reserve, they should consult with Michael Saylor. Maybe not use leverage, but at least buy something every week or every month and hold it for more than 2 years, especially in a period of high inflation or recession environment. The second article, written by Prashant, explains how Tether company, the issuer of the stablecoin, blacklisted an address tied to a miner, somebody who does arbitrage on Ethereum. This selfish entity has attacked bots that were trying to extract value by outpaying fees, known as maximal extractable value or MEV. The result? That entity profited $25 million in a single transaction, and somehow Tether company felt it was illegal. The MEV bots were also doing the same thing to retail users, except on a smaller scale. So those arbitrage bots are paying higher fees, so they have preference on the transactions that are profitable. And the miner did something to these arbitrage bots. He inserted his own transactions when validating the block, so got the money for himself. So it's basically a thief abusing another thief. It's not like regular users have been exploited. It's exploiters, MEV exploiters, were exploited by another entity. There's nothing illegal about that. In this case, the rogue validator address swooped in to backrun the MEV's transaction, leading to losses of nearly $25 million in various digital assets, making it the largest MEV exploit to date. Jayanti Kanani, the co-founder of Polygon, called Tether's action a bad precedent, while Fastlane Labs co-founder Jordan called it the most concerning DeFi development of 2023. He added that the main issue is Tether's willingness to block or unblock large amounts based on activity in the consensus layer, Beacon chain. So there was nothing illegal. No one was hacked. So it's a regular transaction on the Ethereum blockchain. A USD Tether address held about 3 million in Tether at the time of the blacklisting, and a total of 21 million in various other ERC20 tokens. So this selfish entity that was blacklisted held $3 million in Tether, so the stablecoins, and no hacking or illegal access, as far as we know, was used on the exploit. So the big question is, will arbitrage traders continue to trust Tether? If not, what is the impact on the DeFi stablecoin markets? Personally, I don't think a huge change will happen overnight, but this is a bad precedent. It vastly increases the advantages of decentralized stablecoins, but it's not a change that will happen overnight. The third article, written by Andrew Singer, explained how Ethereum's upcoming Shanghai fork could bring additional inflow from institutional investors. Chapella could bring institutional investors to Ethereum despite risks. The latest fork on the roadmap shores up the Ethereum network new validation mechanism while finally allowing stakers to access their ETH rewards. Currently scheduled for 10 o'clock p.m. UTC on April 12th, the upgrade will allow stakers to unlock their Ether rewards or even exit staking entirely for the first time since Ethereum's merge. But how exactly the Shanghai upgrade entice institutional investors in flow? Some institutional investors have been reluctant to lock up funds without a clear withdrawal option. There's probably going to be a queue to withdraw for the first couple of weeks. They might be better off waiting until that comes down to normal levels. It will also reinforce the confidence in the network and in the protocol design so that a developer launching a project can be sure that, for example, gas fees and scalability will not be a big problem over the next 1 or 2 years. So, important thing here, the Shapella fork does not solve Ethereum's current scalability issues. The transaction fees remain above $3 for the foreseeable future, but upgrade prepares the network for the sharding process, so it's an important step. As for the validators unlock, yes, there's a huge selling short-term pressure. There's going to be a queue to withdraw, to exit the validation process and withdraw for the first weeks, maybe a couple of months. But after that, this risk will be a page turned. So my personal view, no institutional investor will be staking Ethereum solely because there's no more lock-up period. They could have simply used Lido, Rocket Pool, or any other semi-decentralized alternative. So if they haven't been staking Ethereum so far, they won't be doing over the next couple of months. A quick recap on today's show brought to you by XGO, our show's sponsor. So Bitcoin's rally above 30K. Some analysts are pinning the rally to the inflation CPI data that is coming on April 12th. I don't think that's fair because gold has already rallied to $2,000 a couple of weeks ago, and Bitcoin rallied 43% between March 10 and March 19. So three weeks before any analyst, macro analysts, were discussing the inflation data. As for Tether blocking or blacklisting a validator's address in Ethereum network, I think it opens a terrible precedent for that stablecoin because the MEV, those arbitrage using validator nodes on Ethereum, have done nothing wrong. They were trading against other arbitrage bots, which were in turn trying to steal money from regular users by overpaying transactions and getting the profitable ones. So it was not a crime. As far as we know, there was nothing illegal. As the news reported, we still don't have the complete details, but it seems like Tether company had no reason to blacklist the address. Lastly, there's Ethereum's Shapella or Shanghai hard fork on April 12th. Yes, there's going to be a selling pressure, but some analysts, which I do not agree, expect that additional institutional investors inflow will happen a couple of weeks or months after the fork, as they will no longer have to wait for a lockup period to participate on staking. I don't agree with that, but it's a couple of analysts' opinion, and you should read the news on Cointelegraph. Well, that's it for today. Don't forget to visit Cointelegraph Markets Pro, the professional alerts platform. Our indicators have been consistently sending profitable alerts. There's a 20% link in the video's description. See you!